You read a lot of conflicting news about dividends these days, but that's really not surprising. But is dividend investing still a sound strategy in this new Corona economy? And just what is dividend investing, and is it the right strategy for you? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. Now, if you're a regular viewer, you know that investing for income is a strategy based on helping to protect your principal while generating income through interest and dividends. And most people generally know how interest works, but fewer have a clear understanding of dividends. We'll try to change all that on today's show with a look at the basics of dividend investing. So just what is dividend investing and how does it work? And moreover, what are the benefits and potential risks? How have dividends and dividend strategies been affected by this crisis? Those are questions we're going to be answering and many more right here on today's show. And joining me, of course, will be my good friend and co-host, Jeff Small, as well as economist Dr. Art Laffer, founder and chairman of Laffer Associates. We'll also get insights from Michael Stewart, the founder of Crystal Lake Tax and Financial, a retirement income store located right outside of Chicago, Illinois. So before we bring out Jeff, let's take a high-level overview of dividend investing. Very simply, dividends are payments made to shareholders by companies based upon their profits. And when I say dividend investing, just to be clear, we're not talking about dividends on preferred stocks. We're talking about regular old common stocks. And when you own dividend-paying stocks, you are receiving a share of the company's profits. If that company has a dividend reinvestment plan or a DRIP plan, you can choose to reinvest your dividends to buy more shares of the stock. Or you can maintain your existing shares and take your dividends as income. Either way, dividend investing gives you the ability to create an income stream from your investment, along with the potential for additional portfolio growth. And that's one of the core tenets of investing for income, which is why dividend investing is a part of the income model. But as with most things, the devil is in the details when it comes to any type of investment strategy. There are many aspects of generating income through dividends that differ greatly from generating income through interest. For example, bonds and bond-like instruments, as I like to call them, generate income through interest and sometimes dividends, but through contractual investments, where they're basically promising that those interest payments and dividend payments will be made. So as a result, at the end of that, not only do you have a guarantee from the issuer of a level dividend or interest payment, but also, in many cases, a return of your principal at the end when an instrument like a bond actually matures, provided, of course, there's no default. Now, in addition to knowing your principal will be paid at maturity, you receive reliable income, like I said, at this fixed rate throughout the life. Now, with dividends and common stocks, you also have the option to receive income, but there is no contract outlining if, how, or when your principal will be returned. Now, does that make dividend investing common stocks riskier? And if so, how can it be a viable strategy for those over the age of 50 who should be seeking to lower their risk? Well, again, the devil's in the details. The simple answer to the first question is yes. The lack of a contract makes dividend investing generally riskier than investing in bonds and bond-like instruments. But there are three important things to understand about that. First, no investment or financial tool is completely risk-free. Second, different people have different risk tolerance levels. Based upon your personality type, your assets, and your goals, you may be comfortable with a certain level of risk in your retirement plan, even while understanding the need to lower your risk when you're in retirement. And third, there are different strategies for dividend investing, some of which can mitigate the risk and align well with your broader investing for income plan. Right now it's time to bring in a good friend of the income generation, our guest, economist Dr. Art Laffer, founder and chairman of Laffer & Associates. Dr. Laffer, wow, what a difference 9 or 10 months makes. The biggest things we had to talk about last time you were on was the China trade war, whether the Fed was going to continue to fight the president or go with the president. And all of a sudden, nobody talks about the trade war anymore. It's certainly not on our top 10 list, it seems, as a country and major issues. And with this crazy crisis, all of a sudden, the Fed has just started being incredibly accommodative. So what do you make of all this?
Well, if you remember the trade war stuff that I talked about, I think I was right. We did come to a deal with China. We did have a deal with Canada, Mexico, and the U.S., and I believe President Trump is inherently a free trader and that he was going to come to those agreements, and he sure as heck did. I was very proud of him. That doesn't mean that we should trade all the military secrets with him and let him tap into our country, but I thought he did a great job. But right now, the pandemic has hit. It's a brand new challenge. I mean, what happened with the pandemic is when it hit, the U.S. was in incredibly good economic shape because of what Trump has done. He had us in solid shape, the lowest unemployment rates ever, the longest continuous prosperity since the last recession in U.S. history. We also had great medical position at the time. We were, I think, the second most number of beds in the ICU beds per 100,000 population of any country in the world, just barely behind Germany. So I think we were in great shape when that hit, and we've responded to it quite well. Now, a lot of mistakes have been made, but you always, when you have something new like that, you have mistakes. And I think we just did a great job handling it, coming through it, and now departing it with great prosperity in sight.
Okay, so that's for the president and what Congress has done. But how about the Federal Reserve? If you had to grade how the Federal Reserve has reacted to this, have they done too much, too little, too soon, too late?
Well, let me just say the most important thing they did is during the pandemic was to guarantee loans. I think it was $4 trillion they put in. I don't know if they needed to do that much. But what they wanted to make sure, and this is the old Walter Bagehot phrase, he was head of the London Economists in the 19th century. He said, in times of crisis, discount freely. What you want to make sure does not happen is you want to make sure that illiquid companies that are solvent do not go under. You don't want illiquidity to morph into insolvency. So what you want to do is have the central bank, the Fed, guarantee those loans, and that's exactly what the Fed did. And I thought they did a great job during the pandemic of guaranteeing the loans and making sure that solvent companies didn't go bankrupt. Now, I think Congress went too far and made insolvent companies that should have gone bankrupt not go bankrupt and wasted taxpayer money. But the Fed did a great job.
So how about looking forward? I know you sound a little bit optimistic about the economy looking forward, and I want to be optimistic for sure. But a lot of economists are still saying we're facing potentially double-digit unemployment through a good part of 2021, maybe through the whole year, just because it's going to take time for certain types of industries to fully reopen. So, can that stall out our recovery? Where do you think we'll be economically with all that at the end of this year and maybe toward the end of 2021?
I don't want to talk about the other economists' forecasts. There are an infinite number of wrong answers, and there's only one right answer. And what I'd like to take you through is what I believe that right answer should be. And we need to get employment back as fast as possible. I think what the president has done with respect to waiver of the payroll tax, if you want more employers, tax employment less. And what he's done is he's reduced the employee tax, which makes it more attractive for workers to work, to continue to work and to earn more. And he dropped the employer tax, which makes it more attractive for employers to hire employees, to work them more, etc., which is exactly what we need right now. We need to have a bam jump in the economy, and that's what he's done, and I've been advocating that, and he's done a great job, and he went against the advice of some of his advisors, I won't name names, but did the right thing, and he went against Congress, which I think was just the right thing to do there as well. So I'm very much in favor of what he's doing.
Great, and I want to ask you in a minute about how devastating it would be with a tax increase under a Biden administration. But before that, even now, so let's say Trump wins in November, great, and keeps taxes low. But you still have a lot of those blue states that might keep things shut down, certain industries shut down because of the virus for longer than others might deem necessary, which again, even though all these incentives for businesses to open up, if restaurants can't open up fully, if people don't feel safe in some of those states traveling on airlines or going to hotels, then still we could be flirting with that 10% or so unemployment rate through a good part of next year. So that's really the nature of my question and possible concern. I want to be optimistic and say that won't happen, but even with the Trump reelection, there's still a lot of blue states with governors that are going to do things like that.
Yeah, let me just say, I don't really want to dwell too much on hypotheticals. What happens if the moon collapsed on the earth? What happens if everyone jumped in the, I don't want to go through a lot of hypotheticals. I don't think we're going to have the COVID-19 problem in 2021. I don't think so. I think we're going to get vaccines. I think that's happening. I think our remedial measures for handling COVID-19 are far better than they were at first, and our death rates are much, much lower, and I think blue states will start opening. They should have probably started opening sooner, but I'm not going to fault them for that. I mean, the one wonderful thing about our nation of states, 50 states, with sort of experiments being done all the time, is that you get some people doing one thing, some people do the other, and you figure out which one's the best, and then all of them follow suit. And that's what's happened. And, I think we've learned a lot on when to open, how to open. But in my view, if you don't feel safe in going into a restaurant, don't go in it. If you don't feel safe flying, don't fly. I mean, that's your personal choice. If I do feel safe going into a restaurant, and I do feel safe flying, and the stewardesses and the pilots all feel safe doing it, I would like to do it without your rules stopping me because you don't want to do it. And I think we're learning that very quickly and very well, and I think it's coming along beautifully. And I feel very sorry for some of the governors who have made mistakes and are now being held liable for those mistakes. Let me just mention one, if I may.
Dr. Laffer, we need to leave it there for now.
Sure,
We need to take a commercial break. We'll pick up as soon as we get back, and you stay with us too. We have a lot more coming from Dr. Laffer right after the break. We'll be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 866-853-7209 for your free retirement income kit. Call 866-853-7209 now.
I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
Call 866-314-7227 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-314-7227, online at theretirementincomestore.com.
Again, there are different strategies for dividend investing that you can follow depending upon your risk tolerance level, your age, your personal wealth, and your retirement goals, as well as other factors. Generally speaking, good dividend investors look for dividend consistency, which is based on how likely it is for a company to continue to pay dividends at the same or higher rate. Now, while some companies provide information to help you make this determination, you can also analyze a company's level of reliability by comparing its earnings to its dividend payments. So for example, if a company is earning $5 per share and is paying out $2.50 per share as a dividend, it essentially has what's called a dividend payout ratio of 50% of its profits. And generally, that could be considered a pretty good, reliable dividend source since the company has plenty of extra profits each year to invest, along with paying its dividends to its shareholders. But dividends depend on both earnings and cash flow, so both should be considered. Dividend reliability is also determined partly by how new or how stable an industry is. But that can change. For example, the current coronavirus crisis has made industries such as retail, airlines, and hotels unsustainable for the unforeseen future. At the same time, as I pointed out frequently on the show, it has strengthened the stability of several other industries, including consumer goods, healthcare, and technology. So here's the point. The stability of any industry is always subject to change based on cultural and demographic shifts, or based upon unforeseen events. And that being said, the overall rule of thumb with dividend investing is to look for companies that have a reliable history of stable income and stable cash flow. With these basic guidelines in mind, dividend investors can then choose to focus their strategy on either a high dividend yield or a high dividend growth rate. The high dividend yield option focuses on slow-growing companies with substantial cash flow, which allows them to fund large dividend payments and produce immediate income. A high dividend growth rate approach, on the other hand, focuses on buying stocks and companies that currently pay maybe slightly above average dividends, but are expected to grow quickly. One of these strategies focuses more on income, the other more on dividend and income growth in the future. So it shouldn't be hard to determine which is more likely to be part of a broader investing for income retirement plan. But again, there's no one-size-fits-all financial strategy for everyone. And as I always say, the right financial advisor can help you create the right approach for you based on all the relevant factors, including your income needs, the amount of time between now and retirement if you're not already retired, as well as your personal risk tolerance level. But what are some of the other potential benefits and some of the other potential risks of dividend investing? And how have they been affected by this coronavirus? We'll be talking about that more coming up in just a bit. And now it's time to bring back Dr. Art Laffer, founder and chairman of Laffer and Associates. So, as I so rudely cut you off because of those pesky commercial breaks that pay all the bills, you were talking about how you feel bad for governors specifically who are being held liable in some way, shape, or form as a result of the coronavirus and their decisions.
Yeah, I was specifically going to focus on Andrew Cuomo, governor of New York. You know, New York got hit really slammed hard by the COVID-19 virus. It did disasters. There were mistakes made, but let me just tell you that the nursing home mistake of New York was not anything that Andrew Cuomo wanted to have happen. He did not. He was not, but I mean, calling him names because of that is totally inappropriate. Everyone knows he wanted to save as many lives as possible, and whatever happened there was a mistake. And, you know, it happens when this type of stuff comes. And so I think we should all understand we're all fighting for the same team. We're all on the same team, and some of them made mistakes, some of them didn't. But that's what happens in experiments. That's what happens when you get judgment calls. And I think holding him liable for any of that stuff is a mistake and wrong.
Well, like the Democrats holding Trump liable, saying, well, we have 180,000 deaths. We would have had maybe only 100 or 120 had he done a national mask mandate. Well, that's great. That's hindsight. But, you know, we're all fighting the battle together. So speaking of the Democrats, and I know you don't want to talk about the what ifs and if a meteorite should come and fall and land on the earth, but I've got to ask you this because, you know, Biden is ahead in the polls.
Yep,
He's
sure
promising a raise in taxes, especially the corporate tax rate. You know, if we have this raise in taxes at this critical point in the economy, what could that do? Could that change everything for us in terms of your economic outlook?
Sure, it clearly could. But let me say two things if I can. Number one, I think Joe Biden is by far the best candidate for the Democratic Party. No, I'm not going to vote for him. I don't think he's as good as Trump by any means, but he's not nearly as bad as Warren or Sanders or these other people. He's really pretty reasonable guy, and I'm very glad he's their nominee. And Kamala Harris, I think, is also really the best choice for vice president. She was a great prosecutor in California. And they're both very normal people who can work with other people. I love that of them. I do think they plan to raise taxes. I do think that will hurt the economy. I do think Trump would do a far better job than they will, but I am much less scared of those two than I am of any of the others the party could have picked. And I think Trump has done a great job, both before the pandemic, during the pandemic, and now after the pandemic. I think he's done a great job and should be reelected. He's great, but I'm not an enemy of Biden or Harris's by any means.
Yeah, I couldn't imagine you saying that you are, so that doesn't surprise me at all. So okay, the stock market. Which really applies to all of our viewers and listeners here in the Income Generation. Of course, now we've hit new record highs in two of the three major indices. has that surprised you that the market's recovered this much, this quickly?
You know, if I may say, the market always surprises me, and I never get it right. Yes, I do. I get it right about half the time. But just remember, the market tells us what will be, not what has been. The market is forward-looking. It's a crowd's consensus type of thing, and it has proven to be far better than any individual on forecasting what the future will be. What the forecast from the market is today, as I see it, is they're telling us there's a very good chance for a Trump victory. Now, personally, I am much more cautious than the market is. I am much more in defensive types of positions than it is, because if it doesn't turn out to be Trump and the market crashes, I want to make sure that I'm hurt the least. I'd much rather not lose money than I would the same probability of making money. So that's where I think the markets are. But the markets are telling us this could be, well, a Trump victory. And I'm very pleased with those results.
Sure. And I'm not surprised to hear you say you're more concerned about not losing money than you are making money, as you are a member of the income generation. You're one of us.
Yes,
so
sir.
To wrap up then, what's your best advice would you give? And I know you're an economist, not a financial person per se, but you know they do go hand in hand to some degree. What's your best advice right now for members of the income generation who are trying to say, well, we don't know what the elections are going to do, what's going to happen, should we be more aggressive, more conservative? What's the best advice you can give them in our final minute in this segment
The best advice on finances is, number one, make as much money as you can. Number two, invest your money as best you can to make the highest return. And number three, spend the money as efficiently as you possibly can. If you're going to live a long time like I already have and like I intend to for a lot longer, you need a lot of money. You need to be frugal, and you need to earn a lot of money beforehand. And God bless you, you'll have a great retirement, a great fun, and great life. Earn as much, invest as well as you can, and spend as frugally as you can to really enjoy life.
Yeah. Well, that's great. It's a combination, like a sporting event. It's a combination of offense and defense. The defense is watching your expenditures. The offense is making in as much as you can through earnings, saving it, and investment returns.
Well.
So it's great words of wisdom as usual. And I'm not one to ever say, you know, well, the markets could be dependent upon the elections, but I kind of agree with you that that is my fear today, that the election could stop this great market rebound we've seen since March.
But just be careful. Just be careful.
So we'll have to see. Maybe we'll have you back to talk about it after the election and see what happens.
Well,
it's been my pleasure as usual.
If you ask me, I'll be back.
Sounds great. All right.
Thanks.
And you stay with us too. We have much more to come right here on The Income Generation. We'll be right back.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable market. There is a more conservative way, and that's to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
As I mentioned at the top of the show, there's been a lot of conflicting news bouncing around lately about dividend investing. And you know, if you think about it, it's really not surprising. With so much economic uncertainty stemming from the pandemic, even the most experienced market analysts are struggling to determine what comes next. One thing we do know is that the crisis has exposed one of the biggest potential risks of dividend investing, and that's dividend cuts and dividend suspensions. And as the coronavirus crisis peaked in the second quarter, companies one by one began suspending or cutting their dividends. Many companies used the same strategy to help protect their bottom lines during the Great Recession in 2008. According to one market analyst, across all United States markets, common dividend payments were $42.5 billion lower in the second quarter of this year than in 2019. Not surprisingly, most of the cuts and suspensions occurred in industries hit hardest by stay-at-home orders and by things like social distancing. For example, retail, travel, hospitality. industries rendered unstable by the pandemic, as we discussed earlier. Now, just a few of the major companies to announce stock dividend cuts or suspensions include Carnival Cruises, Boeing, Delta Airlines, Marriott International, Ford, The Gap, Dick's Sporting Goods. On the flip side, however, some companies have actually announced dividend increases in the last few months. These also, not surprisingly, have mostly been in industries made more stable and more profitable by the pandemic. Companies that have announced dividend hikes recently include J&J, Procter & Gamble, IBM, NASDAQ, as well as the telecommunications giant American Tower. All of this illustrates why good dividend investing isn't simply a matter of picking the winners and sticking with them and riding the momentum upward. You know, anybody could buy an Apple or Amazon and ride the momentum. But with this type of stock market investing, there's a greater element of chance because A, it's not a contract-based investment. B, things tend to change quickly and dramatically in the stock market compared to the bond market. And C, you're not really chasing momentum per se. So much more research and rolling up your sleeves has to be done to be a good dividend stock investor. And all that said, investing for dividends in the stock market can, yes, still be part of a retirement plan geared toward reliable income and to some degree a reduction of risk, provided you have the right risk tolerance level and the right financial advisor working with you to create your strategy. And we'll talk more about that coming up in just a bit. Now it's time to bring in my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also our very own brand ambassador for the Retirement Income Store, as well as Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, you just heard my conversation with Art Laffer, where he said that he thinks whether the markets continue going up or whether they turn and go down, in large part could depend upon the election results, because he's a Trump fan and thinks that if Trump gets in, the market could go higher. But if he doesn't, the promised increase in income taxes for corporations and individuals could turn the market south. So in the real world, when you're talking to our viewers, you're talking to our listeners as you do every day, you know, how do you ride that knife edge? What do you tell them to do and to determine how much they should put here versus there?
Well, everybody's situation is different, Dave. So it's a different answer for every particular retiree or pre-retiree. But, what we do is we have to gauge how much risk they want to be exposed to. Is it a bad thing to be in common stocks and to create income? Well, with maybe a small segment of your money, but it's better to use fixed income assets, things that invest by contract, things that pay dividends and yields to generate that income for you. There are lots of opportunities, though. And for people that aren't taking advantage of those opportunities, it's the ones that are deciding not to do anything right now and staying the course. So you've got to take advantage of opportunities. And there's going to be opportunities whether Biden wins or loses or whether Trump wins or loses. And so I think what we've got to do is make sure you work with an advisor who's going to take advantage of those opportunities for you now, today. Because there are things that you're missing out there as a viewer or a listener. If you're not engaging the right financial advisor, I will tell you, you are missing opportunities right now.
Mm-hmm. Yeah, so I think the biggest problem is those that are within 10 years of retirement or who are retired, but are still in more growth-oriented momentum stocks that aren't getting a good dividend. Maybe it's a combined approach between dividend-paying stocks, in case they think a Trump re-election might cause the market to go up, but then taking some of that stock money off the table and putting it in that universe of bonds and bond-like instruments. Because then if the market takes a major drop, you can become a capitalist, as I always talk about, instead of a victim of the market drop, where now maybe they could take some of those bonds and bond-like instruments and add it to their dividend-paying common stock portfolio. But it seems like the one thing that they shouldn't do right now is just automatically assume that the stock momentum is going to continue and you really focus on dividends as at least part of their strategy, whether it's through fixed income or through stocks.
Well, you're exactly right, Dave. The market is really expensive right now, even though it still seems to be rising. Various pockets of the market are carrying the market. Various pockets of the market have been left behind. And there's lots of quality, great name companies out there that have been left behind that pay very good dividends. There's also very good dividends that are paid in the non-stock market space or in the uncorrelated space. And so what an investor has to do is strike a balance based on what it is they want to accomplish, what their risk tolerance is, what their income needs are, and finding out, what do they want to do through the next 5 or 10 years? What are their needs going to be? And so that's what we have to do, is drill down on those areas.
Yeah, no, you're absolutely right. And like one of the things that I do a lot of times, I'll take somebody who has, this is my need goal, this is how much retirement income I need, but this higher number is my want goal. And if they're risk tolerant enough, I'll say, okay, you could take your need goal, your basic income needs, and satisfy that in the universe of bonds and bond-like instruments. We call it investing by contract, of course, right? And then for the difference between the I need and the I want income for all the luxuries, if they're risk tolerant enough, then maybe that money can go into dividend paying common stocks as an alternative.
No, that's a great balance. It's not for everybody. We know that money is finite, so once you reach to a certain level and you're officially retired on your first day of retirement, the first realization you're going to have is that you don't have any money to lose. And that's really important, because if you lose money, that's money that can't create income for you, and that income can't be created just for one day, but basically for the rest of your life, or until you have to wait to get back to break even. And so you have to strike a balance there. And you got to get involved, because the responsibility is on you as the investor.
And as our viewers and listeners who are retired always tell me, and that the first year or two of retirement is really nerve-wracking, because psychologically, just giving up that paycheck that they're so used to going to work, getting the paycheck, and now when they give that up, it doesn't matter how many times you or I tell them that they have enough income, they're set up properly, it's still an emotionally draining time, because ultimately, if we're wrong, they're the ones that have to go back to work. So, I want to mention that, because I want our viewers and listeners that are not quite at retirement age to understand that that's why, as Art Laffer says, you've got to have more money than you think. And you've got to try to reduce your expenses so that you've got a cushion in case something goes wrong.
Well, that's right. And that's why we say, Dave, the definition of a perfect retirement is having more income than you need. And if you can get there, then that's exactly the spot that you want to be.
Yep. Yeah, agreed completely. And we need to take another commercial break. But one of the things I think a lot of our viewers and listeners, Jeff, don't really understand is that investing for momentum, investing for all the big Apples and Amazons is really easy. When you see the momentum going up, you just kind of grab on the back of it and you go. And it might make you feel like a hero short term, but investing in dividend paying common stocks is more difficult. So right after the break, I can't wait to talk with our good friend Michael Stewart and get his take on that. So you stay with us. We have a lot more to come right here on The Income Generation. We'll be right back.
Diane and her husband dreamed of spending their retirement traveling, but that changed when she became her mother's primary caregiver. Now her day starts before 6 a.m., helping Mom often late into the night. It's a stressful job, but Diane wants the best for her mom. Sound familiar? We thought so too. Caregiving can take a toll on your family, but the Retirement Income Store is here to help. Call 1-888-888-4176 to find out how the Retirement Income Store can help you achieve financial empowerment during retirement.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Now, naturally, it is sometimes possible to have the best of both worlds with dividend investing, to get consistent dividend income and to get some dividend growth and capital growth, for that matter, for your stock holdings. It's possible, but it's certainly not something that you can count on in the same way you can count on the reliability of individual bonds or bond-like instruments. And that said, it's also true that a properly managed portfolio of dividend-yielding stocks built around strategic dividend reinvestment can be a viable strategy for part of your income-based retirement plan, and could be a better choice than the stocks and stock mutual funds that you might currently own. And it may become more viable in the near future if the stock market experiences another major correction that forces it to make fundamental sense again. Once that happens, the extreme uncertainty infusing the market today will at least have diminished, and investors with the right risk tolerance will have the opportunity to be capitalists. How? By getting in at a lower point and riding the next wave up. Either way, bottom line is that if you want to stay in the stock market game, investing for dividends can be a more reliable way to achieve income, as well as a more conservative, as I like to call it, bird in the hand approach for income and income growth. Ken, you asked, I'm already retired, or at least unemployed. I'm starting to understand that taxes are not lower, and you're often very much correct. And there are a lot of factors that reduce your Social Security income. Do you have any advice for me? Well, as I said, the fact your taxes are not lower is something that unfortunately retirees find out only when they get into retirement. All the way up to that point, they work on the assumption that their taxes are going to be less. But you asked me two things, one about taxes and one about reduction of Social Security income. So those are different things, because the reduction of Social Security income, the actual having to pay some of it back to the government, has to do with whether or not you're working and you take benefits early. So if you take benefits at your full retirement age or later, you can work full-time, make as much money as you want, and you do not have to endure a reduced Social Security benefit. However, if you take early Social Security benefits and you continue to work and you earn more than approximately $18,000 in a year, then you have to start to give some of those benefits back. So if you take Social Security early, you're probably going to want to make sure your income is under that $18,000 annual threshold, so you get to keep the Social Security. As far as taxation of Social Security benefits, that has to do with your total income. Income from all sources, including rental income, pensions, income from work, interest and dividends, IRA withdrawals, and believe it or not, tax-free municipal bond interest. So even though the interest on municipal bonds in and of itself is tax-free, it can cause some of your Social Security to be taxable. So how do you get around that? Well, it sounds like you're under the age of 72. I don't know that for sure, so you don't have to take required minimum distributions. So one way to get around that is to try to get as much, if not all, of your retirement income in your early years from non-IRA investments. And if you take it from non-IRA investments, then you don't have all the additional taxable income of IRA withdrawals. And then, depending upon your personal situation, you might be able to reduce the amount of taxes due on your Social Security income. So Ken, best of luck with that.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
Call 866-710-1749 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-710-1749, online at theretirementincomestore.com.
Meet Bob. 10 years ago, he made the shift from investing for growth in the stock market to investing for income. Today, many of his friends are terrified to open their recent statements, but not Bob. Bob is enjoying his retirement, counting his interest and dividends. By investing for income, Bob was able to reduce his exposure to market risk and establish renewable streams of income for retirement. Sound familiar? If not, start with our free retirement income kit by calling 888-888-4176. The Retirement Income Store, where retirees go for income.
Welcome back to The Income Generation. I'm here, of course, with my good friend and co-host Jeff Small, as well as our good friend Michael Stewart. in his fancy corner office, as you could see, founder of Crystal Lake Tax and Financial, a retirement income store located outside of Chicago, Illinois. So I think that's a good point, Jeff, when you talk about the fact that some of these, even though the stock market's hitting new record highs, more than half the stocks are still down in value. A quarter of the stocks in the S&P 500, a quarter of the weighting of the S&P 500 index is due to 7 big technology stocks. So a majority of stocks are still down and still have good opportunities. Isn't that right, guys?
I agree with you, Dave. One of the things one of the opportunities, really, I think there's 2 parts of it that we've been sharing with clients, especially as it relates to dividend-paying stocks, is one, identifying good quality companies that have really low bond yields right now, but their stock dividend yields are significantly higher. Because if there's a low bond yield for a good quality company, that means it's probably good credit. It's mean they're financially strong. That means the dividend should be stable. So if you have the opportunity, like we've been looking at a pharmaceutical stock that is paying about 2% for their bond, but their yield is about 4 to 5% on their stock, and it's something that's still down for the year. So it'll participate in what Jeff was talking about, kind of that catch-up trade as the economy continues to improve. But in the meantime, you're earning twice the yield at the same time.
Sure, yeah. And it's a bond proxy, because at the end of the day, when corporations can borrow at such a low interest rate, can deduct the interest, it's almost like free money. So why not go ahead and take that money and they could support their dividend, which is what's been happening. But also, guys, what if this recovery did get ahead of us in the stock market? And what if, Jeff, you're wrong, and let's say we do have another drop in the market because the market's finally realized that unemployment's going to be double digits for a while to come. Then, how about the opportunity to be a capitalist upon the next market drop? As opposed to the market drops, you're a victim, not having all your money in dividend stock strategies, having your money in other stuff, so now you can buy those stocks when they're on sale. How about that, guys?
Well, I think that'll work, Dave, but it's really hard. That's like us being tactical. It's very difficult for individual investors to be tactical. But there has to be a reason for a sell-off. So what would cause the reason for a sell-off? Let's say hospitalization rates go through the roof and they're overrun, or mortality starts to skyrocket, or the phase 3 clinical trials on the 3 real potential vaccines that we have all have bad news and they don't go to FDA approval. These are all things that can rock the markets.
Or unemployment rate stays in the double digits through the end of 2021, and because certain industries don't come back fully, and then the market starts to realize that. So bottom line, nothing that we talk about today is the be all and end all. Just like you shouldn't have all your money in bonds and bond-like instruments, you shouldn't have all your money in dividend-paying stocks. And I know all 3 of us agree with that. So gentlemen, thanks so much. It's been great having this 3-way conversation here. And you stay with us. We have more to come right here on The Income Generation. We'll be right back. I'd like to take this opportunity to thank my guests, Dr. Art Laffer, and our guest and good friend, Michael Stewart, as well as my good friend and co-host, Jeff Small, for joining me here today on The Income Generation. I also want to thank you, our new and returning viewers. As I'm sure you know, after dropping by nearly 40% in response to the pandemic back in March, the stock market has rebounded strongly, with both the NASDAQ and the S&P 500 reaching new record highs. For the most part, the markets remain fairly high and fairly stable since the Federal Reserve actually dropped interest rates to 0 and then announced open-ended quantitative easing as well as other relief measures back in April. Meanwhile, though, many states have had to roll back reopening efforts due to virus spikes, and the unemployment rate remains in double digits. But also, Congress has yet to approve a second economic relief package as of this taping, and a coronavirus vaccine is still months away. Plus, a presidential election is fast approaching that could mean a rollback of the big corporate tax cuts Republicans imposed 3 years ago. That would almost certainly mean a drop in net corporate profits. And we may see the market start to react to that reality by October with a pullback, especially if they see a Biden victory in the polls. But for now, they remain resilient in spite of all these major uncertainties and many others we simply don't have the time to discuss today. I mention all this to stress again that in spite of how calm and stable the markets overall have seemed, we are still in very uncertain times. times that make it critical to help ensure that you're not carrying too much stock market risk in your retirement plan. The key to that, as I explain each and every week, starts with shifting your strategic focus from growth to income with your investments, away from investment tools geared toward capital appreciation and toward tools focused on trying to secure your principal and earn a more reliable income from interest and dividends. And even if you're fairly comfortable with your level of risk right now, investing for dividends rather than capital gains can still be a more reliable way to achieve income and a more conservative way to achieve growth, provided, of course, you still have the right risk tolerance level and the right advisor. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.